Hi, everybody, and a very good morning to you all. Looks like most people are here now, so I'm going to make a start. As I've just said, good morning. Thank you very much for joining us. We're delighted to see you all, and for those who are regulars at the K3 Hub, welcome back. For those who haven't met me before, my name is Marie Wadeson. I'm a managing director at Quantuma, and on behalf of our parent company, the K3 Capital Group, I lead the K3 Hub, which is a member network for professional advisors, which has been developed by us and other companies within the K3 Capital Group. K3 Hub offers a range of CPD and training sessions, which are not dissimilar to today's event. And we like to think of that as a value add to the firms that we partner with across the group. Normally, I tell you what our group does, but I thought this morning I might do something slightly different and just bring it to life with some examples of the work that we've done for some of our members' clients over the last few months. We've helped your clients in securing a wide range of really great R&D tax credits. You know, we've been helping some of your clients incorporate buy-to-let portfolios. In a staggering number, I looked at this the other day, we've helped to realise the ambitions of over 50 business owners of your clients by helping them to identify and unlock value and helping them achieve really great exits. And luckily, we've managed to secure ongoing advisory work for the advisors, so that's been a great outcome for everybody. With the budget pending, we are currently helping a good number of your clients to solvently wind down their businesses in a tax efficient way. And just in case anybody, has clients who are still thinking about that, there is still just about some time to get that done. So get in touch if that's something you're thinking about. And one other thing that was really, really interesting in the last week or so was that following a period of fairly significant financial uncertainty, actually, we assisted a member's client to secure the long-term viability of their business, which is actually a really well-regarded brand, which has sort of attracted some investment through the first round of funding on Dragon's Den by achieving an accelerated sales. So that was a great outcome for everybody there. Anyway, hopefully that brings to life some of the work that we do here at the K3 Capital Group. And moving on to a bit of housekeeping now. So we are recording today's session. I haven't heard the voiceover this morning that tells me that we're recording, but just to reassure you, we are recording. The webinar will be placed onto the K3 Hub and Quantuma websites next week. Q&A function is open, so please do feel free to ask questions as we go. Just so that we help out Karen, our speaker today, if you could put your questions into the Q&A function rather than the chat, that just helps sort of keep everything in one place. We have had quite a lot of questions in advance of today's session, and we've passed those on to Karen. We have got a lot of content to get through, and it might be that we're not able to get through every single last one of your questions. If that's the case, then please forgive us. We will pass those over to Karen, and she'll be in touch after the session. We are going to put a copy of the slides in a PDF format into the chat, and we'll do this several times throughout the session for people who join us slightly late. We know that today is a slightly longer session, so we are going to have a couple of comfort breaks. They're typically around sort of on or about the hour, and they'll be for about 10 minutes. Right, on to our speaker then in that case. So I'm very pleased to be able to welcome back our speaker, Karen Spate. Karen has got more than 25 years experience working in professional services, both as a solicitor and a chartered tax advisor. She's got her own business providing education services for tax professionals. And Karen is an author and co-author of books on national insurance contributions and income tax published annually by Claritax. And I think if you happen to look over Karen's shoulder, you may well see some of those books.
I've got inheritance tax as well now.
So today's session will broadly cover the difference between tax mitigation and tax avoidance, the governance framework managing tax avoidance, current contested tax avoidance schemes, consideration of available reliefs, exemptions, structures and practices that assist corporate tax mitigation, and also creating a workable and robust even corporate tax mitigation strategy. Just before I go and hand over to Karen, a quick word about our next K3 Hub event. That'll be taking place on Friday, the 8th of November. And we'll be back covering one of our most in-demand topics, which would be commercial property taxes. Event invitations will go out quite shortly, so do keep an eye on your inbox. I hope you enjoyed today's session. Wishing you a great weekend ahead. And Karen, over to you.
Thank you. Let me see. I'll get my slides. Okay, sorry, just get my screen so I can actually see it myself. I'm going to stop that share. Okay, so I'm hoping that you can actually see that screen. I could do the message from, can you just confirm on the chat that people are seeing that before I start? Brilliant, thank you, thank you. Okay, so welcome to today's session. When I was first asked to put this together for you, I started to think, how could I fill up 3 hours with corporation tax mitigation? And as I was pulling it together, I thought, how can I fit it in to 3 hours? There is quite a lot to get through today, so I'm hoping that I've picked the relevant points and that they are useful to you. But if there are any questions that you have, then please let me have them in the chat. We have got a lot of people on today, but I am keeping my eye on them. If I don't answer them as we go through, I will pick them up at the end. If you've got any questions that you do not want to sort of deliver through the chat, then please, by all means, get in contact with the K3 Hub after the event, and I'll be very happy to answer the questions. So I have, in terms of what we are doing today, so our objective, as Marie said, we are looking really at corporation tax planning, mitigation in today's business environment. I want to look at some sort of key opportunities and strategies that we have. But really, before we get into this, I want to think about why we would even care. Before we look at the agenda, why are we interested in corporation tax mitigation? Well, at some point in our business life cycle, as we work through this, then we hope that our business becomes profitable and that corporation tax actually becomes payable. When we do pay corporation tax, it's no surprise, it's a little bit sort of obvious, it's an actual cost to our business. So if we pay more than necessary, then obviously that leads to obvious inefficiencies and will diminish our business optimization. If we get it wrong, then we're really talking about interest, penalties, and reputational sort of brand damage. So really in creating an effective corporation tax strategy, which is really what I'm getting at today, it's all about finding this balance, which of course is easier said than done. So against that sort of backdrop of where and how do we create a corporation tax strategy for our clients and working with our clients, I'm going to focus in the first instance on what do we actually mean by tax mitigation and how does that fit within the whole sort of terminology of tax planning, tax mitigation, tax avoidance, tax evasion, all that good stuff. What do we mean when we talk about tax mitigation strategy? I then want to look at the governance framework that manages tax avoidance. In preparation for this, I read an article that said that there were 64,000 provisions on the statute book that seek to effectively limit our ability to claim sort of corporation tax deductions or to operate corporation tax. So we're not going to be going through all of those today, but what I want to do is think about the framework that we operate in. So as a client, when a client comes to you, and they've got a challenge for you or a situation that you are dealing with, as you look through the rules, you always have this overarching framework that you must operate in. So, like it says there, does this bring into play the general anti-avoidance rule? Are there any specific targeted rules that we need to think about? Does it create a disclosable or notifiable scheme under DOTAS? Obviously, I'm focusing on corporation tax here, but that's the relevant disclosure regime. And what happens if what are the powers that really HMRC have to make us pay or accelerate payment? How can we get comfortable really on working through that? So these are all things that, regardless of what our client is asking us, is the things that we need to deal with and have in the back of our minds. I then want to talk a little bit about the current environment, what's hot on the HMRC's hit list. It's very dull, actually. So just and where are the risk areas? Obviously, I'm speaking in a little bit of a vacuum here because we're just a few weeks away from the budget, but actually I think the trajectory of the current government in regards to tax avoidance and closing the tax gap has already been made clear. We'll talk a little bit about that. And then actually having talked about what we can't do and the framework that we offer, work in, I then want to spend the vast majority of this morning's session looking at how we can optimize our mitigation through tax mitigation strategies rather than adopting any aggressive planning, and definitely not going to avoidance. So what can we do without putting ourselves and our clients at risk? And then how does that roll back? We'll finish off the session by thinking, well, okay, if this is what's available to us, how would we actually go about sitting down with our clients and creating a corporation tax mitigation strategy for them? Okay, so starting with that, hopefully that all sounds good. As I said, if there's anything that you were expecting me to cover that I don't cover, then just let me know. In terms of defining tax mitigation, then I'm just keeping my eyeballs on the chat as well. If you see me looking off to the side, it's because I'm just checking the chat room. So in terms of defining tax mitigation, so, yep, there we are. Probably I'm going to start with a really, really sort of tedious quote. I kind of like these, but there won't be anybody here who's not at least heard of this case, IRC versus the Duke of Westminster, and Lord Tomlin's words are set out there on the slide. This idea that every person is an old case, so we're not gender neutral, is entitled, if he can, to order his affairs so that the tax under a tax statute is less than it would otherwise be. And then it goes on to say, well, if he does order them in such a way as to secure a result, then it doesn't matter how unappreciative HMRC are of his ingenuity, it cannot be compelled to pay an increased tax. And this effectively is, it's been around for years and is the quote that's trotted out to say, you know what? If the law exists and I work within the law, then I can utilize those rules to reduce the tax payable. And that's great, but we've got this increasing public element that has actually almost makes us not voluntarily, but have to think about whether we can go wholeheartedly after Lord Tomlin's approach. So yes, we've don't need to say any more about those. I did. So I was a partner at EY when they were having the parliamentary investigation into the overseas structures around sort of Starbucks and Amazon, and I remember that was very it required key partners within each of the big four and other businesses to stand and speak before the commission, almost justifying the Tomlin approach, and well, that was what that meant in terms of revenues coming into the UK. And so it's all this idea that, you know, Apple, despite the fact that the money they generate at that time, were paying very, very little UK tax. And it is still continues to be an emotive issue today. But so we've had that, and also in real terms, we've had a reduction in what we would call tax avoidance. The Institute very recently published an assessment on this area, and they said that back in 2005 and 6, thought that £11 in every £1,000 of tax was actually avoided, and now that is cut to £2. So we're working in this very much more restrictive environment, and even within my own career, I remember the work that I do now is very, very different from the work that I did 20 years ago in this area. So we're increasingly, as we're acting for clients, we're negotiating a very, very narrow path. And as I've put on that slide, you know, we've got mitigation, which is acceptable, right through to evasion, which is illegal. And it's this bit in the middle, this avoidance piece, it's legal, but should we be doing it? HMRC is definitely of the view that we shouldn't be, and it's that area that we is the one in which we always are thinking about whether we fall into it or not. Now, I have seen some people say, well, you know, mitigation equals planning, and therefore that planning equals avoidance. So let's be very clear here. The avoidance piece is something that we want to avoid, for want of a better expression. But the mitigation is what I would regard as just acceptable application of the principles in an effective way to help the client. So what do we mean by evasion? We definitely don't want to be doing this. This is deliberately ignoring or breaching the rules. So it's where tax is due, but due to improper or fraudulent means, we are disguising the true position. So understating profits, overstating expenditure, and it's knowing that we should be filling in a tax return but not doing it. So we would. It's quite deliberate behaviour. It's improper, and it's a crime. So it can lead to criminal prosecution and even imprisonment. And we have had some sort of famous individuals who have gone to prison for evasion. We don't, as advisors, we don't want any part of this. In fact, to not assist, but to be aware of this and know that a client is not paying tax that they should be paying is actually the taxes proceeds of crime, and we as advisors are at risk of committing a money laundering offence. So it's big no. The avoidance bit's a little bit more tricky. It falls short of evasion. It's not illegal, but we are typically seeing a proactive action on the part of the taxpayer. So, for example, we might create a more elaborate structure or enter into a transactional series of transactions for no other purpose or significant purpose other than the reduction of tax. So, you know, HMRC's approach is very much like, why are you doing this? Is there a commercial reason for doing this, or have you got all these sort of steps in place simply to reduce tax? So if there's no purpose other than that, then we are definitely seeking to avoid tax. Usually the people who do it, so the companies that are firms that are involved in something that is a more proactive structure, they genuinely believe that it's acceptable and within the rules. It's avoidance, not evasion. It could be interpretation. It could be an aggressive risk profile that's been adopted by the company. So they usually believe it's acceptable. However, HMRC and the general public may disagree with that. It's all about this. So mitigation, let's assume that mitigation is our acceptable route. So what does that actually look like for us? Well, it is very basic. It's using the tax reliefs and exemptions in the tax legislation in such a way as to keep tax liability as low as possible. So we have, it's usually reactive. So what we do is we are seeking to apply the tax law favourably to a given situation. So it is most basic. It'll be somebody coming along and saying, yeah, I want to pay as little tax as I possibly can, and you turning around and saying, okay, well these are the exemptions that are available to you. So I say reactive. It doesn't. It usually does take place before the event where people have choices, but it doesn't necessarily involve us doing any elaborate structures or planning. So, for example, the example I've used there is to choosing to surrender losses to a group company to utilise them sooner than would be the case if we just kept them and rolled them forward against our own business. So, we're given those choices as to what we can do with losses when we are a group company, and we choose in one route rather than the other to give us a lower tax burden. Okay. So that's it in a nutshell. We're really looking at this range. We're looking for utilising exemptions, reliefs, and rules that are out there in a natural way. When we are looking to do that, then, as I've already said, we have some like a framework in which we must operate. So, at a glance, then I've put that on the sort of left hand side. I think whenever we do anything, we operate within the GAR, the targeted anti-avoidance rules. We think about clearance. We make sure we know HMRC powers and DOTAS. All of those are worthy of a little bit more detail this morning, I think. But we're reinforced by that. If we get it wrong, we've got penalties and interest regime for both compliance failures and also for enablers of defeated tax arrangements. But it's not only financial. We also have the ability of HMRC to publish details of serial tax avoiders and enablers. I was looking at them yesterday to see what sort of the latest ones are. And there's also a requirement for large companies, which may be some of your clients, to officially publish a tax strategy and country by country reports in terms of where they pay the tax and what amounts they pay. So that is we've got this almost this public domain. So your clients, in choosing to pursue a particular tax strategy, may either have to publish that if they are large enough, or if they fall sort of foul of HMRC, may find themselves input in the public domain. You will know HMRC, they publish, we'll come on to it in more detail later, but they do publish stop notices where they identify firms carrying on schemes that they believe are defeated, and that is picked up immediately by the press. So you can have very adverse business consequences. Okay, so picking up on the GAR, so this can be quite difficult to get our heads round, but I've tried to make it as sort of straightforward and as simple as I possibly can. It's been around for a while now, in excess of 10 years. There are separate regimes for Wales and Scotland where devolved taxes are involved. So what directly affects us for corporation tax, but just be aware of that. So they are slightly different regimes. If you've got a Welsh or Scottish individual sort of taxpayer, who is a shareholder or director, then you have to be aware of that regime as well. But the UK GAR, which is what I'm going to talk about today in the context of corporation tax, applies to tax arrangements that are abusive. And it's the definitions of those that we need to be aware of. So an arrangement is really, arrangement itself is very wide, but a tax arrangement is one where, having regard to all the circumstances, it's reasonable to conclude that the obtaining of a tax advantage was the main purpose or one of the main purposes of the arrangement. So not very different from sort of the the wording that we see all the time and we've seen in case law. It's this idea that the only reason or the main reason you're doing this arrangement is to obtain a tax advantage. A tax advantage is not just less tax, it's also like a generation of a relief or an exemption, anything really that effectively gives us an advantage in the tax world that we otherwise wouldn't have. An abusive as this double reasonableness test. It cannot reasonably be regarded as a reasonable course of action in relation to the relevant tax provisions. And it's super tough. It's actually super tough to apply the GAR. This double reasonableness test is there to protect the taxpayer, and the burden of proof is on HMRC. Which makes a change because normally there are assumptions in favour of HMRC, but this time it's up to burden to HMRC to prove that it's unreasonable. There's a GAR advisory panel that must authorise any action by HMRC. Effectively, they look at any scheme where they think the GAR might apply, and they will say whether the double reasonableness test is satisfied. If the GAR does apply after all these safeguards, then the tax advantages are counteracted by making such adjustments as are just and reasonable. So they don't work. The main thing about the GAR is that you can't get clearance, and you do need to take it into account when you are completing the return. So effectively, you have to self-assess as to whether the GAR is relevant here. So it requires us as advisors to always think about whether the GAR is a potential application. And so we just, again, I include it in our framework because when it first came out, everybody was worried that HMRC would just use this for everything. In fact, they don't. It's very limited. What they tend to do in practice is rely on targeted anti-avoidance rules. So it is very much a backstop, but because we have to self-assess, we do, as advisors, need to make sure that we have on our files effectively covered ourselves that we are happy that this doesn't apply. If GAR applies after we get it wrong and it counteracted tax, the penalties are up to 60% of the counteracted tax. So just checking on the messages. Okay, so as we said, in terms of practicality, the GAR is very much a backstop, and we much more likely HMRC will seek to apply what we call a targeted or specific anti-avoidance rules, so often referred to as SARS or TARS, because we love acronyms in the tax world. And these are specific, this is just a generic term for specific rules within the legislation that's designed to stop abuse of any particular exemptions or reliefs. So it's nothing sort of more sophisticated than that. The format tends to be in one of sort of two ways. One is that you will be denied an available relief if there's an element of avoidance. So if there's something that has no commercial purpose, then you won't get the relief. And that's to effectively stop people shoehorning their scenario into somewhere where we get the relief, or it might just actually modify or restrict the application by altering the parameters. So we could just have a straightforward, if there's no commercial purpose, this isn't applying, or saying, what, in this particular scenario, then this rule or relief will not be available. So we'll alter the parameters. And as I say, it's much more commonly relied on than the gap. So I think we need a bit of an example of key areas that are really covered by TARS. Otherwise, I'm just talking. I've talked to you theoretically so far, but I actually quite like the practical. So, the first one is if we try to manipulate residents, where we are a multinational group, to reduce tax overall, then there are rules that effectively widen the definition of UK residents and will disallow particular deductions or bring other areas into tax. And we kind of seen that with the Pillar 2 minimum tax rate of 15%, which effectively reduces the impact or some impact of using tax havens for our structures. Hybrid mismatching arrangements, they're huge. So there's a massive area of risk for HMRC. This is where we try and use our structures, our groups, to generate a deduction for corporation tax purposes without an associated tax charge elsewhere. And in terms of employees, this is, if we look at the stop notices, I think there are 33 stop notices in issue at the moment, and I think 32 of them relate to this attempt to generate a deduction without triggering an employment income charge on an employee. But we also see a lot of hybrid mismatching arrangements in the international groups of companies, where we can have a deduction in one country for a particular payment whilst having it exempt or when received in another. So we do see some structures like that. We again taking advantage of rules around groups. So we'll come on to group relief later on this morning, but there are lots of TARs which kind of stop us exploiting that, other than for its the stated intention, which is to create a level playing field between groups and companies and single entities. Yet we've got a main corporation tax rate that's different now. It's 25% to 19%, depending on your size, with marginal relief in between. The golden days of when we had one tax rate have gone. That means that people are desperately trying to get into the 19% instead of the 25%. So there are lots of TARs that stop us trying to divide up our business between associated companies to take advantage of that rate. Losses are a huge area, so artificially generating or acquiring losses to set against taxable profits. We'll see that when you look at the loss rules, there's lots of exclusions and rules to prevent its exploitation. Buying gains to utilize losses is a big thing at the moment. So when I said I'd do a brief review of what is the sort of schemes out there, people who have losses, generated losses, actually getting gains in to offset them. It's a bit of a different rule, because if we've spent years trying to acquire losses to set off against taxable profits, it's now sort of been flipped over. And of course, always sales and leasebacks to try and generate a taxable deduction whilst not actually losing use of the asset. So those are areas. Now, specifically, so we expect TARs in all of those areas. They're all over as well, but those are the ones that are really sort of fraught. at the moment. In terms of a specific example for you, if we think about the loan relationship regime, then a company can obtain a deduction for any interest losses or expenses it incurs in respect of its loan relationship. But if it has an unallowable purpose, then any debits or exchange gain credits are not taken into account if they are attributable to that unallowable purpose. And an unallowable purpose is a purpose which is not part of your business or commercial purposes, and specifically includes securing a tax advantage where or an activity purpose which is not within the charge to corporation tax. So that's an example of that sort of that first type of TAR, where it deliberately calls out, prevents the rules applying where there is a tax purpose or a non-commercial purpose. So I've just randomly chosen that. I quite like that because that comes up quite a lot in practice. So, for example, an unallowable purpose we know would be promoting the personal interests of a director. So, if we are trying to sort of effectively deal with this in order to push our director's interest rather than the company's interest, then that would be an unallowable purpose under this. Okay. So I think I got a question before, the thing about clearance. So when we are operating within our framework and we see these rules and we start thinking, well, I've really no idea whether they apply or not, we've got a number of options open to us. We can consult with colleagues, we can consult with organisations that are there to assist, such as the Institute of Taxation or your professional organisations, maybe even K3 can help. And we will have in occasions we do discuss things with HMRC. We do have a provision for statutory clearance, but this and where we can seek advance confirmation from HMRC about the tax position. But this right to clearance in advance is very limited. It's where there is a specific legislative entitlement. And the most common ones where we have entitlements, pretty much the main ones there, I think I've only missed a couple of out, is transactions in securities, which is really useful where we are actually doing anything to do with shares, so paying dividends or selling shares, buying shares, restructures, demergers specifically where a company is buying its own shares, or where we are having a reconstruction for capital gains or chargeable gains purposes. That's not so much for corporation tax, that's around the capital gains tax implications for shareholders where we're reconstructing companies. But all of those provisions have an anti-avoidance element where you cannot take advantage of the tax regime if you don't have a commercial purpose, or if there isn't a tax avoidance element. So we can actually seek advice about that in advance. Now, the question that was asked to me was like, well, what is the process for that? Well, pretty much we have to put everything in writing. HMRC will look at that and they will give their answer on the basis of our application. If therefore the application is not complete, then they are not bound to rely on it. In terms of timing, timing therefore becomes key because they have technically 30 days to respond. If they raise questions on it, then you answer within 30 days and they then have another 30 days to respond. So you could end up it being a minimum of 60-day time frame. So you don't want to be sending it in until it's complete. So that does involve, for like reconstructions and transactions, actually having nailed down the details of the transaction, including valuations. So it is quite it's something to think about up front, and it is something to build into your timetable and to allow, but it typically it depends what you're doing at the moment and who's dealing with it. Then they're quite speedy in some respects. Sometimes you're getting an answer within 1 to 2 weeks, but if they raise questions, it starts the clock running again. So you do have to. You can't guarantee. So you can't say to your client, "Oh, we're going to get it within 2 weeks." You kind of have to say they've got 30 days to respond, and just do your absolute best to make sure that it's a complete one. And there is there is guidance on what you should include in statutory clearance applications on the government website. It's probably pushing beyond our scope today to go into any more detail than that. In terms of our other things, there's nothing ever to stop you picking up the phone and asking HMRC, but unless you're going to involve into negotiation, so this is like a non-statutory clearance. But generally, HMRC will only give you non-statutory clearance in advance where the information, or you're looking for something that cannot be found by reading the guidance or having used the helpline. So your helpline is your sort of first port of call. Of course, you've got to be concerned as advisors as to where you are on that you are complying with confidentiality, but fundamentally a helpline. And then if you can't find that and there is uncertainty about HMRC's interpretation of tax legislation, so either they haven't given guidance or can't help you on the helpline, or it's actually an uncertain position, then you can seek non-statutory clearance. A very common area where we get in non-statutory clearance at the moment is in connection with employee ownership trusts, where they are confirming that contributions to employee ownership trusts to pay interest that the trust owes are not being, are not treated as if they are dividends. So that's untaxable. So that's a very common area where we get in non-statutory clearance. But fundamentally they can't be asked to approve tax planning arrangements, and they will not give clearance on matters of fact. It's different where we need a valuation. I'm not thinking here that when I talk about non-statutory clearance, I'm not talking about valuations. Often we need valuations as private companies to be agreed with HMRC. But they won't comment. You do a valuation, they don't comment on whether what you're actually doing works or not. They're just giving you a value of the company. Okay. So rest of the framework, DOTAS, again, another quite relatively dry area, but I think we can tackle it this morning. It's still fairly early days. We have to notify HMRC where there is an arrangement where such arrangement will or might be expected to enable a person to obtain a tax advantage, and that tax is covered by DOTAS, which does include corporation tax, and the advantage is or might be expected to be the main benefit or one of the main benefits of the arrangement. Again, we're starting to see this same word in tax advantages, where it's the main benefit or one of the main benefits of the arrangement. And for DOTAS to apply, it has to be hallmarked. And the hallmarks are listed in the DOTAS regulations. So whenever we have that, then we have an obligation to notify HMRC that we are doing that. And how and when depends on whether we are classed as promoters or not. So if it's something we develop in-house, we don't get out of it, but we do have a different sort of time frame. So indeed, the hallmarks and the obligations vary depending on whether a promoter is involved. And a promoter is someone who in the course of their business is providing to other people services relating to taxation. And they have to be if they're responsible for the design of the proposed arrangement, or they are making the firm approaches to other people with a view to making the proposal available for implementation, or they make the notifiable proposal available for implementation by others. So we can't get out of it by saying, no, I've had this great idea, but you do it. I would still be a promoter if I had been responsible for the design, or even if I've not been responsible for the design, if I go and I market it or I approach someone. So I'm talking, a client comes in and I say, oh, yes, there's this scheme you could, this is what you could do. If it is in the course of my business to do that, then I am a promoter. So HMRC take a very wide view of this. A lot of the legislation in this area is around the whether someone falls within the definition of promoter or not. You don't typically fall in the definition of promoter if you are just providing sort of legal services or sort of support services for that. So if you were, for example, a law firm who was drafting the documentation, that wouldn't in itself make you a promoter. It's more around the people who are designing and pushing it. However, as I've said, the whole idea is that you can't use an intermediary entity or person, so don't get away from it by saying, well, I've designed it, but Fred down the road is doing it, and he's got a company, and that's a separate legal entity. Their legislation cuts through all that. If you've no promoter, it doesn't mean you don't have to notify, but it's still, as I say, it's a different time frame altogether. And it is the main hallmarks. Before I talk about this time frame, the main hallmarks are listed there. We're looking for confidentiality, either from other promoters or from HMRC, a premium fee. So sometimes rather than just time spent at our usual rates, we're looking for a extra fee, often linked to the amount of tax saved. If we're promoters, we're looking for standardized tax products. So if we've got brochures, if we've got precedents that we use, we've got standard documentation, it's like a bit sort of we start off the shelf and we just tweak it. That's a hallmark scheme. There's then specific arrangements which HMRC really, really hate. Loss schemes, which is where we generate artificial losses. Leasing arrangements, which are the sale and lease backs. Employment income, which is really around the third party disguised remuneration, loans, they don't really like those, and certain financial products. So if they fall within that, even if there's none of this sort of confidentiality and premium fee, it still becomes a hallmark. This is really high level. If you are operating and selling, devising schemes, you should always have DOTAS on your checklist. You should always look at it. Now, most firms have panels who look at everything that is being done and decide whether it's something that's notifiable or not. If they decide it's notifiable, then effectively all employees are told, and if they have to do it, then they will make the disclosures. The main worry about this is the time frame, because disclosure has to be made by the scheme promoter within 5 days of making the approach or making the scheme available for implementation or becoming aware of a transaction that forms part of that scheme. So it's not about implementing, it's about talking or making it available. So that client who has come in and we say, look, why don't we do this? And I've got this scheme and it's a notifiable one because I've got a premium fee and it's standardized. That's when I've had to have disclosed within 5 days. Huge risk for firms where you haven't got a tight process in place for your employees, because who knows, you could have somebody, I'm sure you won't, but you could have someone who was inadvertently done a notifiable arrangement and then you're not aware of it as the partners, so you haven't done your notification. It's such tight time frame. Weekends and bank holidays are excluded from the day count, gives us a little bit of a chance, but it's still incredibly tight. So it's the promoter who does it rather than the scheme user. But the scheme user also has obligations if the promoter is based outside the UK, or if the promoter is a lawyer and they're claiming legal privilege as to why they're not making the disclosure, or there isn't a promoter at all. So it falls then on the scheme user. Um, and that scheme user can often be employees. That could be quite grim. If you've got someone who is an employer and they've put in a scheme for their employees, and then it's the employees who are effectively sometimes treated as scheme users. It can't be good. It's not all for them. If you design and implement your own OMAT scheme, so you're in-house, typically, then you have to disclose it within 30 days of it being implemented. So there's no need to notify of things you're just chatting about. It's once you've put it in place, then you have to notify. So very, very different. And as I say, I'm sure it's something that people have when it first came out, people were having sort of sleepless nights over how they protected their firm. So I'm sure you all have your processes in place, but it's always there. Make sure you don't fall foul of it. Um, because these everything you've got to do, you will notify HMRC. HMRC will give what they call a scheme reference number, and you must give that scheme reference number to any users of the scheme. You also have to tell HMRC of the clients that have implemented that scheme. The scheme users then have to include the scheme reference number on their tax returns. It's in the white space you use on their tax returns. And then employers also have to give it to their employees where they have an employment related scheme and provide information about the employees to HMRC. So we've got lots of things going on. If HMRC thinks there should be a disclosure and they've not had one, then they can actually issue a notice requiring them to supply the information so HMRC can decide whether there's been a failure or not. And the failures are big. So it's up to £600 per day if you fail to disclose. Um, and because of the tight time frame, that can be months. If you do not provide then a scheme user with the SRN, so you go to all the effort of getting an SRN, but then you don't pass it on, then there's penalties for that. And there's also penalties for users who don't put their scheme reference number on a tax return. And that actually can be, so that combination gives quite a lot of powers. So it's very easy to sort of go through the legislation and say, oh, yes, that's there and we comply. But the consequences of not complying gives HMRC a lot of power to deal with it. None of the penalties are compulsory, but they're all things that HMRC can apply if they feel that it's appropriate to do so. So it's when they sort of, and the whole idea of DOTAS is to accelerate HMRC's response. If you think about before DOTAS, you would implement something for a client, they would put it on their tax return. If HMRC didn't raise an inquiry, they would never really find out about it. Eventually, it might filter out, but you're using this sort of confidentiality. They start seeing tax, a few years down the line, they start seeing all the tax not being paid, thinking what's going on there, and then they bring legislation to deal with it, or they fight it, whatever they choose to do. With DOTAS, it's giving them early notification of a scheme, so it means that they can respond much quicker. So in terms of an example, then, it's HMRC versus Hyrax, just been in the news very recently, although this is 2019. It's in the news for sort of continuing on, but I think it's quite useful. So the IRAT scheme operated as follows, that UK employees would effectively quit their job and take up a new employment contract with a UK trust. The UK Trust would then rehire their new employee out to the previous employers, but taking their earnings and an 18% fee. So as far as the employees were concerned, they were just now employed by the UK Trust, but on a day-to-day basis, they were just doing their job as usual. The 82% that the trustees would receive. So the trustees would receive an amount from the previous employer. They would keep their fee, and the rest of it would be split into salary, which was to comply with the minimum wage rules, and then the rest would be provided in the form of a loan to an employee. And then the trustee transferred its right to be repaid the loan to an offshore trust in Jersey. And then the intention, as it was found in the cases, that the loans are never repaid. Now, bearing in mind what we've said about artificial steps, it doesn't really take much to see that this is totally artificial. All that's happened here is that the employees have stopped being employees and they've entered into a really complex structure to try and get there to save effectively the national insurance and also the employment taxes. So it could have more value going to the employee, which means that we could pay less, we could save national insurance. So you can imagine that HMRC did not like that at all. So at first tier, first of all, they were looking at whether they were a promoter or not. A lot of the arguments were that they were the Hyrax Resourcing Limited that was selling this scheme. They argued that they were not a promoter. But fundamentally, because they put like a fairly complex structure in place, but they found that they'd accepted applications from users, they'd actually created the employment contracts, they actually handled the money, and they did do the loan agreements for the offshore trusts. Also, the scheme users were paying Hyrax the promoter fees. So the fact that there was money going to Hyrax for their services was enough for the tribunal to say that they were promoters. And then scheme, it's having decided that Hyrax was a promoter, they then have to decide if it was a hallmark scheme. And they said yes, it clearly was meant to give rise to a tax advantage. The obtaining of the tax advantage was the main benefit. It was really hard to see what else they were doing with it. And it was clearly a standardized tax product with premium fees because it was rolled out for a number of people in a similar way. And however, Bosley Park and Peak Performance Head Office Services Limited were not promoters. Their activity was around sort of advertising the schemes and talking, but they weren't. So they felt that that actually wasn't enough to make them promoters. So just really sort of advertising in itself isn't enough to trigger it. But it is quite a it is quite draconian. So I've spent a little bit of time on that, but it is an area that people sort of are aware of and are nervous about. But actually, they should be nervous. So you need to always think about it in the context. People think more about DOTAS than they do about the GAR because the GAR has all its protections, but DOTAS is this. It's so quick, the time frame. We need to sort of get that involved. Now, just noticed in terms of the time, let me just check on my messages. Okay, right. Yeah, so let's talk a little bit about information about HMRC powers. It's relatively short, this, and then we will have our break, and then we can kind of get onto the good stuff, I suppose, the actual what do we do to help. So when in my framework, I said that we have to be aware of HMRC powers. The power of HMRC actually helps inform our decision making because we want to work through and effectively not fall foul of what HMRC can do to us and our clients. So in terms of information, just a reminder, I've got numerous thing. So just a brief reminder, HMRC always tend to use an informal approach to obtain any information that they want, i.e. they ask you. If you don't give up the information, then they can issue a formal information notice to and to produce documents, but that must be reasonably required to check the company's tax position. Generally, we advise to, I would advise to cooperate with HMRC where you can, but they do like fishing expeditions, so and like know your client visits, but on the whole, you should really cooperate, because that will ultimately minimise fees and penalties if they are due. They can direct their requests to both the company or to a third party. But if they're going to address it to a third party, it's really where they cannot get the information from the taxpayer itself, or the third party is a financial institution and it isn't too onerous for them to get the information that they want, or if they don't know the taxpayer. Where they don't know the taxpayer or they cannot get the information from the taxpayer themselves, they would need the approval of the tribunal, assuming the taxpayer doesn't consent. So, yeah, and if you have got a third party notice and they are aware of who the taxpayer is, then you will get it copied to you. Tribunal can disapply that requirement. They only really do that if the taxpayer is unknown, or if they think there's a real risk of an immediate loss of revenue, so that somebody would say, for example, abscond. Remember that if the company has actually submitted its tax return, they can only exercise their information powers if they have reason to suspect an inaccuracy. So again, if you've got a tax return in respect of an accounting period, then they can't fish about that. They've got to have some sort of reasonable suspicion. You can't be required to produce a document unless it's in your possession or you have power to procure it. They can be required to produce information relating to the conduct of a pending appeal. So if you've got your documents and your evidence and your sort of your witness statements and things, that you can't be forced to produce them under these information rights. It will be part of the disclosure in the conduct of the appeal. Any sort of personal records that you've got or privileged information also doesn't need to be produced. And there's a right to appeal. Rights to inspection, then. Well, they can enter business premises and inspect those premises and documents there if they need it for the purpose of checking the tax position. Inspections can be announced or unannounced. If they're announced, they tend to give at least 7 days notice. But if the HMRC officer, a fairly senior one, or a tribunal authorizes it, then they don't need to announce them. So that's quite important, because you do need to think therefore about how your documents and things are kept on premises. Remember that you don't have to produce certain information, but so therefore that information you might not want to leave sort of lying about. So if it's information that the HMRC would like access to but they've no right to, then you wouldn't necessarily want to just have it laid out in the coffee room. So those are I've included those because it is part of the framework, understanding what you can do or not do. But in terms of our corporation mitigation strategy, it's kind of right on the edge. I guess more relevant for HMRC powers is their ability to handle serial tax avoiders. So if we have companies who have used defeated tax avoidance schemes, then they can be placed on warning for 5 years. if they, during that 5-year period, if they use any more defeated avoidance schemes, then can have enhanced penalties. They also have a reporting obligation, so they have to inform HMRC whether or not they've used any arrangements to gain a tax advantage, or whether they've done any arrangements that are disclosable under DOTAS or the equivalent for VAT. So we've got this like for 5 years, we kind of got the sword of Damocles hanging over our head. If we don't comply with the notification requirements, then HMRC just extend the warning period. You could be on it sort of indefinitely. Once you've had 3 warning notices in respect of schemes which are used and defeated, so you really are a serial tax avoider, then they will be your details are published, and you can have a what we call a restriction of relief notice, and that just means that you can't make any claim for reliefs during the period of restrictions, and that can be extended if you do further defeated schemes. So fundamentally, it's like if you have a client who is a serial tax avoider and keeps using schemes, then they've got this reporting obligation, extra penalties, and they could end up having be prevented from utilising normal reliefs that should be available to them, just really to put a stop to it. So it's you don't. I mean, I'm hoping you don't have clients who are in that position, but you may have to. Someone may come to you and need that kind of help. It can be very, very damaging for a company's reputation. So will feed into their strategy. Now, just be aware of follower notices, because this does also impact on people entering into schemes that we know are aggressive. Within 12 months of a judicial ruling, then the HMRC can issue what we call a follower notice, which means that if you are in dispute, so there's an open inquiry with HMRC, and you've got a tax advantage from something you've done, and the judicial ruling was relevant to the chosen arrangements, and you've not already got a follower notice, then you can have one issued to you. If you get a follower notice, your client gets a follower notice, they've got 3 options. They can either just hold up their hands and say, you know what, we've done this scheme and we know it's been defeated, so we can pay the additional tax, interest, and penalties and agree that with HMRC. We can make written representations to HMRC. There's no right of appeal against a follower notice, but you can write to HMRC on the argument that they've not met those conditions that I've listed, or it's not relevant to the arrangements, or they're out of time. And they will have to either withdraw or confirm the notice, or you can just ignore it and pursue the case against HMRC. If you ignore it and HMR subsequently succeeds, then there will be enhanced penalties. Because the follower notice isn't in itself that, we've got the risk of extra penalties, but let's face it, we wouldn't be fighting it if we didn't think we would win, then HMRC can also issue with the follower notice an accelerated payment notice. And this is basically saying, you know what, we think you've got a tax advantage, we've given you the follower notice, or you're using a DOTAS scheme, or as a GAR counteraction notice in respect of those arrangements. So what we want you to do is we want you to pay now, even though the appeal has not yet been determined. The only representation that you can make to HMRC is that they've not met those conditions, or that the amount stated is incorrect. And that failure to comply gives rise to extra penalties. It's a non-payment penalty, so you're getting into 5% if you don't pay by the due date, which is, I think, 30 days after the notice is issued. And then there's additional 5% at the 5 and 11 months afterwards. So, you get the follower notice, you're going to be like, I'm ignoring this, we're going to carry on fighting it. And you get the accelerated payment notice, which means you are in default. In those circumstances, you kind of have to advise the client to pay. And then you will obviously get refunded if ultimately you succeed. And as you can imagine, this is like really we see a lot of this in connection with sort of loan arrangements and EBTs. And of course, all these various schemes that exist to prevent employees paying full tax. Okay, and then the final thing on this is just stop notice. It is which is all part of actually preventing the tax avoidance in the first place, which is around promoters telling them to immediately stop promoting particular arrangements. And they can only do that where they think it is more likely than not that they do not work. It's usually schemes that are subject to DOTAS or follower notices because they're all sort of out there. If you get one of these notices, you must stop promoting the scheme. And we are giving copies of notices to relevant persons. We must tell everybody we've got a stop notice, and we have to give HMRC information about who is promoting and using the scheme. So Jane, I can see. Quick question there from Jan. Okay, yes, I think that this is where tax mitigation has come in because in my day it used to be tax planning, tax avoidance, and tax evasion, and tax planning was is much wider. And I think HMRC are trying to make tax planning almost like a dirty word. So I think we're talking about that that slide that we did right at the beginning with the sliding scale of trying to narrow mitigation and increase avoidance. So I think if we move towards mitigation, sorry, you can't see the question. So Jan has asked the question to say it makes her really mad to hear HMRC use tax avoidance as a derogatory term, even though it's legal. So just try to think of another phrase. And I think that's where tax mitigation has come in. So sorry about sorry about that. I didn't realize we couldn't see the chat. But yeah, it's a very sort of emotive debate. Every firm and every advisor has to make a decision as to what they can and can't do. Clearly, if we all did the same, then we wouldn't have this need to discuss it. We wouldn't have to have this framework to work in. I'm not for a second advocating that nothing works. I'm kind of just saying that there's an increasing view about what is and what isn't acceptable. But again, our job is to minimise the client. So we will just finishing that off. So the problem is, well, it's not a problem. It's a criminal offence not to stop promoting or to give out copies. It carries an unlimited fine and or 2 years imprisonment. As I've said, there's 33 stop notices issued as of yesterday when I checked. Penalties can be huge, up to 100,000 plus 5,000 for each person the arrangements are proposed to, and this can can be increased to 1 million if they decide that if the person's making so much money that it's like, oh well, we can pay 100,000. It's great. So yeah, it is actually quite a big deal. It's very limited. It's like a last resort. If you are the recipient of a stop notice, then you can appeal it, but you have to stop dealing with the scheme. We do have conduct and monitoring notices as well. This is where it's like warning shots about actually we're watching you, they don't just leap in with the stop notice. It's very much like the guard. It's like a last thing to protect sort of taxpayers. The vast majority of us, whatever, we need to think about all these, but we'll come across them, but our job is to navigate through them for the client. Okay, so before we go on to current trends and like what we actually can do, I think that's a good time for a break. So we'll break for sort of 10 minutes. I'm going to let our admin people sort that out. I'm not sure. So we will be back then at 10:25. Thank you. And I will look at my questions whilst we're on a break. Okay, so I think that's about 10 minutes on. It's the thing about doing things online. You've no idea whether anybody else has come back or not. But before the first break, what we looked at was really sort of setting the scene, like what is our dial between tax mitigation and tax evasion, and what is the framework that we need to operate in order as advisors to be able to help and assist our clients without causing sort of damage to reputation or indeed additional sort of tax liabilities. So what I want to do with the rest of this morning is to talk about, well, okay, we've looked about where we to tread carefully, but what can we actually do? This is a session about corporation tax mitigation, so I guess at some point should actually get round to trying to mitigate some tax. But let's again, current trends and what's going on at the moment that we might like to see. Well, I found this slide really interesting. It came out very recently, just a couple of months ago, around the UK tax gap. So the UK, what we mean by the tax gap is the difference between what we should be getting paid as a government and what we are actually getting paid. And you'll know that this is a big focus of the new government to reduce that tax gap. But what we can see is that if we look at this year, the latest stats, 22, 23, the vast majority, so 45% of the tax gap is really down to our failure or the client's failure to take reasonable care or is error. So as advisors, even moving away from, say, avoidance or what avoidance or mitigation is or any of that debate, we can see that there's lots of assistance that our client population needs. Now, that 45% of failure to take reasonable care or error might actually be is people who are not seeking proper advice. I'm not suggesting for a second that they are getting the wrong advice, but what it does mean is that there's life for us yet because there's all these entities that need assistance of professionals. So to reduce that percentage, and we can see that that percentage hasn't really changed over the last few years at all. So we've got this sort of 45% where we're in the error and failure to take reasonable care. By the other end of the scale, avoidance, so people actually actively going out there and avoiding tax, represents only 4% of the tax gap. So it's very small amount proportionately. Money-wise, it's still quite significant. I think it's around, I've got it on there, it's 1.8 billion. And what interested me was that actually the of that 1.8 billion, half of it, so it's 0.9 billion, just under, relates to corporation tax itself. So I was kind of not expecting it to be corporation tax, but it still is the biggest amount that is avoided technically is corporation tax. And when I investigated that further, as we said, most stop notices and SRNs from DOTAS relate to payments to employees or shareholders that seek to fall outside the income tax and NIC regime. So a lot of the discussion is on that, and certainly that is the main thing. But a lot of the value of the 0.9 billion remains in the hands of a few really large multinationals who have taken multinational sort of structures. So that's why it represents such a big proportion. But really, as I've said, for us, we just those are the two things that you keep coming across, which is this anything to stop employment income being employment income, and then actually utilizing overseas structures so that we end up paying a lower rate of tax in a lower jurisdiction than we do in the UK. I mean, we were actually at risk as a country with a 19% corporation tax rate of becoming a tax haven ourselves. 15% is like the cut-off point that they agreed on under Pillar Two. But yeah, we were only at 19%, so we were up there in sort of low tax jurisdictions, but not anymore with the things. So the key thing is, as we said, 1 billion, not 0.9 of the avoidance tax gap relates to corporation tax. So it's still highly relevant for us to make sure that we don't slip into this avoidance. But as I've said, the key areas, as I looked into it, was the big multinationals that were generating the value of this avoided percentage, and it actually all those key areas of risk that we've seen the TARs that I discussed with the TARs came up again in terms of the areas that were actually generating tax savings in a way that HMRC doesn't like. So that shouldn't come as any surprise whatsoever. The whole purpose of introducing TARs is to shut down those particular schemes, and you see there's sometimes that's successful, sometimes it's not, sometimes there's workarounds. Always say to students of mine who are studying for exams that if you look at the legislation and it's got letters in it as well as numbers, then that is usually something, well, it is always something that's been bolted on. It usually represents an attempt by HMRC to stop something that has come up that works through and around that legislation. So against that, how do we optimize? How do we sort of think, you know what, I'm going to give up and I'm not going to do anything like this because I don't want a risk of tax avoidance. I don't want to be accused of helping money laundering. It's just too risky for me as a client. Well, actually, our job is to help our clients sort of minimize the tax they pay through the use of legitimate tax planning strategies. And the golden rules of sort of tax mitigation are set out on this slide for you. So we always look first and foremost to see if we can exempt any tax. And in terms of exempting tax in corporation tax context, is can we actually put our company or our activities out of scope? So a non-UK resident company will only be subject to corporation tax in respect of certain activities. So if we can pull that off, then that will take us. Remembering, of course, that if we are if we are non-UK resident, we will potentially be resident somewhere else, so that would put us into that tax jurisdiction. And of course we have the Pillar 2 minimum, which is coming on. There is exempt income, so is there something we can actually like have as that's exempt for us? Pretty much is dividends, and then there's the substantial shareholder exemption, which is incredibly useful. So we'll come on to that. So I think those three are worth having a look at in a little bit more detail. Where we can't exempt income or chargeable gains from corporation tax, then we try to seek to minimize it. So by minimizing it, we're either looking at reducing the amount that is subject to UK corporation tax, or maximizing the deductions that we can take off of that income to reduce it to its taxable amount, or whether we can get into a lower tax rate. So we can't exempt it, it is taxable, but actually can it be as low as we can possibly make it? And there's a whole list of things that I want to discuss today. Now I've put two areas in italics there, and I've done that deliberately because when I when you look at losses, that is a whole subject on itself. I just do not have time today to talk about the effective use of losses, and I've justified taking it out because in terms of the K3 hub, it tries to align its discussions to the various stages of business. So if in this stage we're making money, we might have losses to use or we might not. But if we do have losses, that effective use of those losses can make a big difference. So maybe, you know, one day I may come back and do a session on that, but it's very high level today. And the other thing is the double tax relief and overseas branch elections. So when we are cross jurisdiction, I've already said that if we end up being non-UK resident, we could end up being liable in another jurisdiction for tax. We could be potentially entitled to credit for any tax that we pay overseas, and that could be by virtue of domestic rules in the UK or through a double tax treaty. Now, it is again a very big topic in itself. We would always want to operate where we have the availability of double tax relief in a way that enables us to use that double tax relief. It is not the case that we get automatically credit for any tax we pay overseas. We typically are limited to the tax that we would have paid in this sort of country. So if we're paying tax at a higher rate in an overseas jurisdiction, we won't get credit for all of it here. So it just is about making sure that we generate enough sort of profits in the UK to utilise that. So again, a very big topic. Gonna just leave it at that for the purposes of today. And the final thing is if we can't exempt it, if we can't minimise it, then we always seek to defer it. We live to fight another day and hope that we can effectively, the theory behind that is that we can invest the gross amount and the return will help offset future payments. And the main one for that is reinvestment relief, which I really think is underused. When you look at the scale of it and how wide it is actually something that is very useful. So let's picking up some more of those and what that might actually mean for us in terms of our tax mitigation. So I said the liability to UK corporation tax is determined by the residence of our company, and they will look to, so it's the place of incorporation. So if we are incorporated in the UK, then we are a UK resident company, but we will also be UK resident if we are incorporated outside the UK, but our central management and control is in the UK, and there is a whole range of tax cases on central management and control. So it's HMRC take an approach case by case. It's a matter of fact rather than a defined. So it isn't just about, well, I'm not the director, it's like the actual central management and control. So setting up a company overseas, having a board of directors overseas is not enough if actually the board of directors acts in accordance with the instructions of someone who is resident in the UK. That would be enough to make it UK resident. So you pull it off by all means, but you do have to, it has to be real. So rather than just, you know, we'll pretend we've put this structure in overseas and we'll be pretending it's non-resident, it won't work. If we are UK resident, then it's our worldwide income and gains are subject to corporation tax, but we can elect to exempt the profits of any overseas permanent establishment. So if we operate a branch or we do activity in an overseas jurisdiction, to the extent that we create a permanent establishment, typically we need a place of business there, or we need someone like concluding contracts. We sometimes accidentally set up permanent establishments because we send somebody to do business somewhere. What happens then is that for the profits attributable to that permanent establishment is taxed overseas. Effectively, you have to register for corporation tax in the overseas jurisdiction. Now, because we're UK resident, theoretically, we also have to pay profits. We have to pay UK corporation tax on that and give credit for the overseas. But we are allowed to elect to exempt it from UK tax, which we will do if it's to make sure that we if it's a higher rate in the overseas. So again, that can be very useful if you run through permanent establishments, but it's a very specific fact pattern, and that's what we'll find as we go through the rest of this morning. Some of these things will be wholly irrelevant to your client base. Other things will be like, yes, we do this already. It's going to depend on the nature of the company. All you can do is know the full range and then bring them to play at the relevant sort of fact when the relevant facts present themselves. So if we can get a non-UK resident company, then we will only pay UK corporation tax to the extent that the income and gains are attributable to a UK permanent establishment. So if we don't operate business in the UK, then there's no point being a UK resident company. If we can effectively be non-UK resident, and even if we have a UK permanent establishment, what we can do is we're making sure that any income and gains that are attributable to overseas activities are taxed outside of the UK rather than in the UK. And again, if we are operating in a lower tax jurisdiction, that it actually operating in the lower tax jurisdiction, then that might be useful. But even if we have managed to avoid a UK permanent establishment, then we also need to be aware of three other areas where we could have a UK corporation tax liability. The first is if we are dealing in or developing UK land, if we are disposing of interest in UK land and buildings, or if we have profits from a UK property business or other UK property income. So when we've got essentially, if we've the company that we are dealing with, even if they are non-UK resident, if they've got UK land or property, that needs to raise alarm bells for us in terms of a potential corporation tax liability. But we can see from that if we operate outside of that space on the slide, being non-UK resident could effectively help us with our UK corporation tax liability. And as I say, it all depends on the rates. And that's why we often lower the corporation tax rates to encourage inward investment, because the lower our corporation tax rate is, the more likely we are wanting to be UK resident and getting credit for overseas tax that we pay rather than the other way around. Okay, so I said that I would mention the substantial shareholding exemption, which we use a lot in practice. So gains are not chargeable and losses are not allowable where a company disposes of shares in a trading company or the principal company of a trading group where they've held at least 10% of the ordinary share capital throughout a 12-month period beginning no more than 6 years prior to the disposal. So it doesn't have to be the 12 months immediately prior to the disposal, but just as long as in the last 6 years we've held at least 10%, when we sell that shareholding, we will not have any chargeable gain. Equally, if we've got losses, they are not allowable. It's all to do with number crunching, because obviously if we sell our subsidiary and we're not taxable, but we've got that cash, so we still can, it doesn't return to shareholders other than like through a profit extraction method, so we wouldn't necessarily sort of tax it at that point. But it can be useful in terms of when we are making sales, particularly if we are doing some, we can also use it for hive downs. So as we've seen a lot of business rationalize themselves, this can be really useful to get rid of a business, but without actually triggering some a tax liability on the company. So just a bit about ownership. We can count in ownership by other members of the group and shares. So if we've got a company that's got it's owned by one subsidiary and then the shares are passed to another, then that would be that counts as long as we've got this 12 months in total. Also, if within doing the 10%, we can add together shareholdings of the same group. And I will do an example so that we can see what that means. So, well, all those out there thinking, but I thought that transfers between groups, between companies within the same capital gains tax group take place at a no gain, no loss basis. They do, and transfers do continue to be prioritised by Section 171. So if we are moving things around in the group, including shares, then that will be done on a no gain, no loss basis. But what is interesting is that when the assets, the shares are sold, it doesn't say there, we won't suffer the degrouping charge. And indeed, if the shares being sold relate to the company which has been acquired trading assets from another group member, the periods of ownership of the trading assets can also be taken into account to satisfying the 12 months. So effectively, this will allow us to apply the substantial shareholding exemption where we create a new co and hive down a business to that new co in order to sell it off outside of the group. So this is an incredibly useful exemption where we'd remember we're only sort of selling the shares though, so selling the business would be quite different. So we would, in terms of the investee company itself, the company must not carry on non-trading activities to a substantial extent. So we're not talking about selling off property investment companies. We're talking about selling off a trading entity, and that must that's quite a long-term commitment. It's the trading must take place from the start of the latest 12-month qualifying period right through to the date of disposal. So we're looking at trading companies. When we talk about non-trading activities to a substantial extent, it doesn't mean that we can't have any investment activities. It just means we can't have a substantial amount. And a substantial amount is not defined by statute, but it's taken to mean 20% of something. An HMRC will look at 20% of whatever suits. So it could be the time spent on doing the non-trading activities by key individuals. It could be 20% of the assets. It could be 20% of the income stream. It could be 20% of the profit. So they look at it holistically to say, you know what do these non-trading activities mean to this company? But so we are looking at selling either a trading company or the assets, so the business has been transferred to it. It must also continue immediately after the disposal if if the connecting parties are involved, or in fact, if we're relying on this hive down provision. So remember what I said about being able to create a new co and hiving down our business and being able to count that as the 12-month. If we're relying on that to create our 12-month qualifying period, then the biz trading has to continue immediately after the disposal, like it's a genuine hive down and sell off. So it's an equally if we're moving it to connected parties. So we can, in some circumstances, still claim the exemption if it's not trading at the date of disposal, but if it has ceased within the previous 2 years. So it's so if we've stopped our trade and now we are selling off our shares. That really covers that. Okay, so what does that actually mean for us in practice? Because I know I've thrown a lot of information at you, and you might be thinking, yeah, no, I'm not really seeing how this is working for me. But say we've got a parent company and it's got two wholly owned subsidiaries, Company A and Company B, and they each acquire for some bizarre reason that we won't go into 5% of the ordinary share capital of Company D on the 1st of January 2024. A few months later, parent co incorporates a new subsidiary, Company C, And then immediately after that, B decides it's going to give its 5% stake in company D to company C. And then parent company sells off company A to a third party purchaser. That company A has 5%. So at the same time, we're going to sell off our other 5% from company C if all the entities are UK residents. So yeah, I'm reading that. I'm saying that. I wrote this about 4 days ago and it's not making any sense to me. But fundamentally, we've got, for some reason, we've got subsidiaries within our group where they have each have 5% stake, two of them in a third party, and they want to effectively transfer that as part of the sale. Only one of the companies is going to the third party purchaser, so the other company that's staying in the group also wants to get rid of its 5%. So the remaining group doesn't have any shares in this other entity in D Limited. Right, so remember that if let's assume these are trading companies and that we're not actually pulling economic ownership means it's sort of genuine. When that's all fine, but when company B transfers its 5% stake into another company in the group, that would be a no gain, no loss transfer, so with no tax consequences then. When the parent company sells company A, well, that's just exempt under the substantial shareholding exemption. It's owned that company for a long time. But we've got this C selling its 5% stake in company D. And that actually, it hasn't had it that long. It's only had it since the 1st of January. But actually, it can amalgamate the time with the other company B to make up its qualifying period. So that is also exempt under the substantial shareholding exemption. So as I say, really love this in practice because we wouldn't also have we don't have any kind of degrouping charge either in respect of that intergroup transfer. So we could make, as I say, there's a million fact patterns that could apply to, so I'm not really going there here, but I think it is something to just mark down and remember that if we are selling subsidiaries, we are selling trading entities, we need to make sure that we can utilize the substantial shareholder exemption. If we can, then we're going to have no tax charge at all, and actually the sale of those shares would help. It doesn't in itself trigger a degrouping charge, just it's a way around it. But the other thing, so we talked about, so we talked a little bit about non-residents, we've talked about substantial shareholding. In terms of dividends, I'll just mention that before we go on. Most dividends that we receive are exempt. There's a few tiny sort of exceptions to that. Where we've got overseas companies, for example, if we were under the control foreign company rules, but fundamentally that's in the vast majority of cases, dividends that we receive into the company are exempt. So that can be a really good way of extracting profit where we are a non-UK resident company and we have a UK subsidiary, then we can extract profit into that company very tax efficiently. So in terms of if we can't exempt, we're going to minimise. The key thing in minimising is maximising the deductions we can use, which sounds super, super basic, but actually when you speak to most clients, they've not fully got this nailed. So you either have the client who has incorporated their business and treats the company as their sort of own personal sort of money box, which can cause us some compliance issues, or we've got people who just don't think that to maximize the deductions. And we can need to maximize the deductions in one of two ways. One, we can just make sure we actually record it and get the deduction that we deserve. Or if we've got choices of things that we are going to spend our money on, we might want to spend it on something that is more tax efficient than something that is not tax efficient. So as we said, there are a number of deductions available for expenditure. Some of them are statutory. Key legislation there is 53 to 92A of the Corporation Taxes Act 2009, and others are based on general principles. We love this. So if an expense is income in nature and is incurred only and exclusively for the purposes of the company's trade, so payments for raw materials, if you are a manufacturer, then that would be a deduction on general principles. Now, I think somebody asked a question on contributions into pension schemes, so it's probably a good time to mention this. Yeah, if we make a contribution to a pension scheme for our employees and we're not, that should be a tax-free benefit, and we will get a deduction normally for that. I'll go there. That would normally be income in nature. The issue we always have when we make contributions to people's pension schemes is it only and exclusively for the purposes of the company's trade? And if that can be problematic, if, for example, the company is ceasing trading. So if it's part of a redundancy payment or a termination package. So we have to be really clear that if we are doing it as part of a termination, that it is for the purposes of the company's trade. Usually if they're signing up to something, then it is, it's that we can justify it the only time, because we're saying this is how we compromise. But if we are ceased, if our trade has ceased, that's more difficult, but there is a statutory deduction there. But on the whole, it's usually anything to do with employees is deductible unless it's unreasonable in scope. So your big risk with companies is that you decide to extract a massive amount through a pension contribution to a main shareholder. That would be okay as long as you could justify the level of pay. So if people were normally paid £300,000 a year and you made a contribution that was 300,000, then you're fine. If actually normal pay is 300,000 and it's like 2 million that you're paying in for some bizarre reason, I won't go into like tax, your annual allowances and the like, then that would you may struggle. So it's all about creating your justification for the amount. I think the question was also about annual allowances, but yeah, you've got your 60,000 annual allowance. A contribution by a company counts towards that. The allowance may be reduced if you're an high income earner, and the contribution is taken into account in your working out your adjusted income. So it could bring it down. You can roll forward unused allowances from the preceding 3 years. So sorry, that's a little bit off tangent, but somebody asked about the principles of getting a deduction for making a contribution to an employee's pension scheme. So that's that one. But so that would be an example. But some basics we have to think about when we are advising clients. We should have our golden rules, really. More golden rules. I'm a big fan of golden rules. Everything that can be deducted should be deducted. As I've said, sometimes you look at clients that are just not benefiting in the way they should. And that means usually that you have to have processes in place to ensure that the correct amount is deducted in the correct period. I do remember when I was a trainee solicitor, so I'm a lawyer by background, and I went to a client's office to collect their documents. My principal at the time sent me to collect and sort out their books, and it was a scrapyard, and the guy had massive dogs, and he took me to this porter cabin, and you've never seen, it was just like it was just a mess of paper, and it were a bit grubby. And he said, whatever you do, he said, I've got to go, but whatever you do, don't leave this porter cabin because the dogs will get you. So if you need anything, you've got to ring me up. It was in the days before mobile phones, so it was like that. And I thought, he said, but I'm going to come back for you. And I was just like sat there. It was okay. I didn't have any incidents, but I just thought, do you know, if this is what I trained to be a lawyer for, was that? But fundamentally, that wasn't unusual. Now, these days, with everything being more computerized, you should be able to have easier processes, but you will be amazed how many clients are not really focused on these deductions. So we need the audit trails and the proof of expenditure. That goes without saying because we might have to justify it in our if we have an inquiry from HMRC. But there's not only corporation tax itself to think of. We are doing corporation tax, but remember, if I talk about the stop notices, are all about reducing national insurance and generating a corporation tax deduction at the same time. So actually, like the contribution into a pension scheme, which is tax and NI free at the moment, pre-budget, but still generates as a corporation tax deduction, those things are extremely valuable. So we do need to, it's not just about whether we made the payment, but it's can we make a payment that is tax effective for everybody else and get a corporation tax deduction. That's definitely where we should be going. So some examples of areas that are tricky or where people don't make the most of it from my experience. I've got charitable donations, clients entertaining and gifts, lease and hire purchase, termination payments and premiums on short leases. So just looking at those briefly. So we're doing fine for time. So if we make a qualifying charitable donation, then these are allowed as a deduction in arriving at our taxable total profits for the accounting period. And that can be cash donations, which are always paid gross by a company, gifts of shares that are on a qualifying recognised stock exchange, which includes AIM for this purpose, or gifts of UK land and buildings to charity. So all of this is sort of like, you know, if we're going to make cash donations to charity or we want to make charitable donations, then we can do it tax effectively by saying channeling it through the company can reduce our taxable total profits and effectively reduces the cost. It's not a way of generating money, but it is a way of reducing the cost of our donation. Just bear in mind, because this is where it all gets tricky, that if it is akin to sponsorship, then we get it just straight away deductible from our trading profits for tax purposes. So the reason why we would prefer it to be deductible from our trading profits rather than from our as a qualifying charitable donation is really when we're dealing with losses. Because when we deal with losses, we will set them off before we take account of our qualifying charitable donations. So we lose the benefit of that if, for example, our losses cancel out our trading profits. Whereas if we can get a deduction from the trading profits, it generates a loss in itself if it goes below the profit. So you just sort of think about that. If you are wanting to do a donation to charity, then sponsoring an event or doing t-shirts, all that sort of stuff with your logo on, so it's really would get us a deduction from our trading profits rather than being a qualifying charitable donation. So it is just something to look at if you are wanting to give. Definitely try and make it like sponsorship is what I would say, rather than a qualifying charitable donation. Okay. In terms of entertaining and gifts, most people know generally that costs incurred by a trade in providing business entertaining are disallowed. So, we put on the day at the races and all that kind of thing, that's disallowed. Good reasons for that is that, we could, if we are a relatively small company with small shareholders, we could effectively run our social life through our business under the guise of business entertainment. So it's just disallowed. However, in terms of business gifts, they're usually disallowed as well, unless we've got the total cost in any accounting period to the same person's not more than £50. And it bears the business name and it's not food, drink, or tobacco. So the giving of a water empty, because it's not to drink, a water bottle that's branded, or pens, or whatever it is that you get that's sort of a freebie, as long as they're not food or drink or tobacco and they haven't been £50, then they are deductible. But more interesting, I think, is just a couple of things that are problematic for us. As well as stuff that we can work. So first of all, the problems. If we give discounts, we need to be really careful that they are not disguised gifts. So, doing something for somebody on the cheap could be regarded as a gift rather than a discount, and therefore the costs that are dealt with incurring that is effectively a will be disallowed. And we'll talk about the consequences of that in a minute. I think I've got an example on the next page. But also think about gratuitous gifts even where you provide a service. So the big example they use there is that where you get a speaker in to have an event, to speak at an event, and you give them, you pay them, and you give them flowers at the end to say thank you. That will still be a gift and still be disallowed, even though you've got a service in return for it. So you might think, oh, this is part of my cost of getting the speaker. It would still be regarded as a gift unless it was part of the contract. So if the contract says, if the speaker says, I'm not coming unless you give me a bunch of flowers at the end, and that's part of it, then that would be deductible. If it's not, then it's a gift and it's disallowable. So where you are getting a service into the business, then you should think really carefully about whether you bother with gratuitous gifts at all. Most people don't really expect them. So yeah, if you want to be generous, you're not getting you're not getting a deduction for that. And as I say, the disguised gifts through discounts also would give us a problem. In reality, where we offer discounts, there's still a lot we can do. So rather than now focus on what we can't do, I just want to turn it around and think about what we can do within those rules. So obviously we can give gifts that are within the clear exemption. I've already given you the logo printed water bottles example. That seems to be the gift of choice this year. We can give discounts on sale where the original cost is covered. So if you think about it, the legislation is all about expenditure, not about profit. So fundamentally, as long as we have we've got our original cost of providing something is covered, then we'll be fine. That discount on sale has no impact on our sort of disallowance. So I buy something in for £100. I normally sell it for 200, but I actually am going to sell it to various people who I like. I'm going to let them all have it for £120. I would still be able to disallow the 100, even though I've actually effectively given quite a lot of value away. Because it's, as I said, the legislation's all focused about the expenditure. That's what our expenditure is, so it's not caught. So we can do discounts in that way. Now, if it's a commercial transaction and we discount even below the cost, then we'll be all right, because it is all about gifts and gratuitous sort of and entertaining. If so, for example, we've got short date goods, chocolate shop that everything's going to run out, and we'll let everybody, we run them round and sort of say, oh, we'll give them all away for £1, or a donation to charity or something, then that should be okay. It's not a gift, it's like a necessity to get it out of the building. So heavily reduced short date goods, you can argue, is a commercial transaction. We're getting £1, they're normally worth £100, but we're getting £1 for it because we actually that's all we could get, and that's better than throwing it away. If we give offers gifts to customers who purchase a certain level of goods, on the sound of it, that sounds like a gift, but really it's a discount on sale. So Nespresso, for anybody who's got an espresso machine and actually buys anything from the Nespresso shop, they're always giving freebies away. And so use free Nespresso cups if you order 100 capsules. That looks like a gift, but really it's built into the cost of the provision, or should be, and therefore we can count that as a discount on sale. We would still get the deduction for the Nespresso cups. And then gifts that are actually part of a sale and effectively paid for by the customer are actually okay. So there's this tradition that if you buy a new car, you might get a bunch of flowers with them. You could say, well, you know, when we worked out our sale price of our car, then we factored that in. Now, I do think that there's some tradition there, but really it's all a matter of proof. So it all comes back to this process. Can we actually, can we prove that it's been costed? Well, we can look at that by looking at our cost projections. So it's all around looking at everything in the business that looks like it might be a gift, and then actually thinking, is it a gift? Is there some way we can structure it so it actually is deductible? All these small things really add up. Against gifts to charity are okay. Also, gifts of this is probably like one of the most useful ones for people who are looking to build businesses. So gifts of items that it's in our trade to provide, and we give it away in the ordinary course of trade to advertise to the public. So if we give free yogurts away, if we're a yogurt manufacturer, that's all right. You see them in the station, in the tube, we're giving them out. They're all deductible. If we are a free, if we're a handbag producer, we could give a free handbags away. We can, even though it talks about the public, we can have it really selective. So we could give our handbags to social media influencers. It kind of has to be something. And I think at the back of my mind there, we've got the gifts to Lady Starmer, for example, of clothes that by certain designers, they would seek to have them deductible on the basis that this is like advertising of their brand. So we can use that. What you've got to be really careful of is if you produce yogurts and you give a handbag away, then unless it's £50, less than £50, it's got your logo on it, which is not going to be usually attractive, that is not going to be deductible. So actually, I think in terms of your business, there's quite a lot to look at to make sure that your clients have not just said, oh, these are gifts, we can't deduct them. There's quite a lot that you can make deductions for. Now, in terms of lease versus hire purchase, the key thing here is whether is the flat rate disallowance of leasing costs that we get for when we lease cars with CO2 emissions that exceed 50 grams per kilometre, unless it's like a hire car for a short time. So pretty much when we we're getting an item in, we might buy it outright. But if we get it on hire purchase, then it's going to be treated as if we own it from the start of the contract, and we're effectively paying it off by installments, even though we don't own it until the end. Technically, we will be treated as if we own it from day one. Therefore, our repayments will contain both an interest and a capital element. The interest is going to be a debit under the loan relationship rules, and we may be able to get capital allowances on the capital cost of the asset if it is subject to capital allowances. From a lease, the entire lease amount will be deductible, either because it's an operating lease, which is pretty much where you have no responsibility for the item. That will be just deductible as income. For finance lease, there is an element of interest and depreciation, but this is the only time that depreciation is allowed as a deduction. So the asset is recognised on the balance sheet, even though we're not ever going to own it, and it's depreciated over its useful life, but we are given a deduction for it. So there might be it might be slightly different in terms of timing, but fundamentally you will get a deduction over the life of the lease for the full amount paid. But you just, again, you need to crunch the numbers. Just remember that flat rate disallowance, that can be punitive. So you wouldn't necessarily want to go for that option if you did have these higher emission cars. I mean, generally businesses are moving towards low emission cars anyway, because there's so many sort of tax disadvantages with high emission cars as opposed to low ones, that you wouldn't necessarily go for a higher emission car if you can help it. Okay, then for termination payments, I think I've more or less sort of referred to this. Just be aware that non-contractual payments are deductible under general principles, but as we've talked about it, when the business ceases, and I said there was a statutory amount where the business ceases that you can deduct. I think I've more or less covered that earlier, so we'll move on. The only thing I would draw to your attention is if the termination payment has a direct link to a sale of shares, then it's usually not allowable. And I've given you a case name there. So, for example, if we are selling shares, that will be a capital payment for the shareholder. I'm talking about a shareholder sale here now, where that shareholder is an individual. But if we say, you know what, as part of that sale, we're going to give you a termination payment as well because you're leaving after you've sold the shares, chances are that's not going to be deductible if you make sure it depends very much on your documentation, so be aware of that. Premiums on short leases, just to make sure that we've not forgotten that we can take a deduction for amounts of premiums that are paid on short leases. Basically, when we have a short lease that is granted, that's 50 years or less, then part of the premium that the landlord receives is chargeable to corporation tax as property income, rather than being a capital receipt. And the amount there that is chargeable to corporation tax is the premium times 50 minus the length of the lease divided by 50, where Y is the length of the lease minus 1 year. So the tenant can deduct the amount of the income paid spread over the life of the lease. So if you've got a tenant who is entering into, so you've got a client who is taking out a lease, it's a short year lease, they're paying premium, then that part that the landlord is taxed on as property income is also deductible for us as the tenant. Okay, and I think I did an example there, and I think that 10 should be a 9, not a 10, but effectively you can see how it works. So we will get that CT deduction. So I spotted that error there. So that would be 50 minus 9, 41 divided by 50. Yeah, it slightly reduced the deduction. So, and then just a few other bits there. Sorry about that. I will have to amend those slides. Costs incurred as a result of having company status, they're always deductible. Anything that's stolen by employees is deductible as long as it's not the proprietor or a director. Trade subscriptions that we have to recognised professional, well, not professional bodies, but trade bodies would be deductible. Any sort of business rates are deductible. even though they're related to land, we still see that's still treated as a trading deduction, as are the costs of registering a patent, even though a patent itself could be a capital asset. Then there's various ones out there. So there's various local enterprise organisations that carry a specific statutory tax deduction. And if we are establishing tax advantage share plans or employee ownership trusts, there is a deduction for that. Just be aware that that doesn't extend to the EMI, Enterprise Management Incentive, that ordinarily those costs are disallowed because they are capital. So just bear those. And incidental costs of obtaining loan finance. Again, although that would be a loan relationship debit, it's still allowed. So those are just, as I say, it might seem like a little bit of a random list, but it's kind of is where I've come across situations where people have sort of not claimed it when they should be, which you might want to think of. Just be aware though that removal expenses are normally allowable, but they're not allowed if your move is expansionary. So if I've got a business that's moving to significantly larger premises, then we could argue that some of the removal costs are an enduring benefit for the trade. And that can be really sort of bad news because most people do move for expansion. So you just need, I'm just flagging it there. You just need to work your way through the detail on that, but just it's a warning shot. Similarly, the cost of setting up a website is capital expenditure because it will bring an enduring benefit to the trade, but update costs are more likely to be revenue expenses. So again, you need to, if you've got an element in your payment of initial outlay and then maintenance, you need to really separate those out so that you can, or have a documentation that separates it out so that you can claim the revenue expense. And fines and penalties, even not just HMRC, even where they are imposed by professional bodies, are generally disallowable. Okay, so that's all my deductions. It's a bit quick canter through. The area that I want to, just thinking now we need another break. So I'm going to take another break now for 10 minutes. And then we'll do the last half hour on the capital allowances and reinvestment allowance. Okay, so we're back at 11:30. Okay, so while we're just waiting, I think somebody did ask a question. I'm hoping the person who asked the questions are there around what we have to watch out for if we have we're non-UK resident and we have dividends paid to us. I'm thinking that this was meant as a non-UK resident individual rather than a non-UK resident company. But if we are an individual, we've got a couple of things to watch out for. Yes, the dividends are paid to us gross, but we should check the Section 811 ITA cap because dividends are disregarded income. So effectively they can be tax-free. They're paid gross but treated as if they have got a basic rate credit. Rather, tax is treated as if it has been paid at basic rate. So you get that, but also you've got this Section 811 cap, which might operate. The downside, so it's incredibly efficient. The downside is you have the equivalent of the temporary non-residence rules that you have for capital gains tax. Also applies where you've got a closed company and dividends are taken out that represent non-resident profit. So if somebody amasses profits in a closed company, moves overseas, strips them out through dividend that treated as disregarded income, usually tax efficient, and then but come back to the UK within 5 years, then it will be treated as a taxable dividend on return. So those are the two things that I would really look out for. If your question wasn't about an individual, if it's an overseas company, then yeah, there's no withholding You just have to pay the dividend. Remember, though, that if we are a company that is if we're an overseas landlord and we're receiving rents, the deduction scheme for overseas rents does pay, so it's deducted at source unless you apply for it gross. So hopefully I've caught that there for you. If not, then just let me know. Right, so half an hour left. Really want to look a little bit at capital allowances and some of the other reliefs that are available, and then want to look at how we might go about sorting this out and taking this forward in a way that might actually turn itself into some fee income. So capital allowances, really, really important to maximise these. Sometimes we have choices as to which capital allowances we should apply. So I want to really talk about that. And also remember that capital allowances are used by the government to drive particular behaviours. So that buying effectively environmentally friendly assets will attract higher capital allowances than others. So I've no intention of going through this in detail, but I've summarised on this slide all of the allowances that are available at the moment to a corporate entity. We've no longer in the super deduction range, but we do have ongoing sort of full expensing. The key thing is for first year allowances, we need to, it's really for new plant and machinery, except cars and leasing assets, and with certain new electric cars and vehicle points. So when we have that first year allowance, when we dispose of that asset, then we do have to look at the balancing allowance and balancing charge, which we don't normally do unless the trade is ceasing. So that's the downside of the first year allowance. So the impact of that it does lead into our choices, which I think is more useful for us. So if we've got a choice priority, we sometimes get a situation where we might be able to claim both a first year allowance and an annual investment allowance. But we will be guided by our decisions. So the 100% annual investment allowance applies to a wider range of assets. So it will include second-hand assets and special rate pool assets that otherwise would only attract 50%. It excludes cars though. And however, the 100% annual investment allowance is limited to £1 million of expenditure, where the first year allowance is at 100% is indefinite. If therefore both, so whenever we have something, we look to see if we can get the 100% allowance. If we can get both first year allowance and annual investment allowance, then and the expenditures within the annual investment allowance limit, then we usually claim that as the preferred option, because we, as I've said already, it avoids this immediately balancing charge on disposal. If you have incurred expenditure before the 1st of April 2023 and it sort of and you're still dealing with an accounting period which sort of straddles that date, then you might qualify for the 130% super deduction, which is like a no-brainer in terms of if you can get it. But we just so we used to always be, yeah, we get the super deduction, but actually, and ignore, the annual investment allowance we don't really need. But now, because of the needs for balancing charges on disposal, the annual investment allowance has become useful. Again, just as a quick example, therefore, we've got CA Limited, innovatively named, and they've got a balance brought forward on their general pool of £16,000 at the beginning of the year. During the year, they buy a number of items, including an electric car, second-hand electric car, and a hydraulic car lift. when I'm doing the capital allowances, I can get a first year allowance on the electric car. The only annual investment allowance that applies to my three things is the hydraulic car lift, because cars are excluded from the annual investment allowance. So of course I'm going to claim that for the hydraulic car lift. That's great. I really want to do that. But in terms of what's left, I then look at my first year allowances. I can get for the 40,000 first year allowance for the electric car, but the second is not new. So the second hand one has to go in the general pool. Because it's electric, it's general rather than the special rules. So it'll get its writing down allowance of 8%. 18% rather than 6%. Oops, that wasn't supposed to happen. So very quick. I'm very aware of time there, but fundamentally, if you that's there for you to look at afterwards. But our rules are: can we get an annual investment allowance for it? If we can we get a first year allowance? If not, where does it go in the general pool? And just really understanding that and making sure clients understand that up front they may make a decision as to what purchase they make, because that 25,000 that they've paid for their second-hand electric car, yes, it was cheaper, but it's going to be written down at 18% on a reducing balance basis. Whereas the new electric car, they're going to get a 40,000 deduction immediately. So my impact on our structure. Now, research, the next few slides, research and development, and when I get there, I've got a patent box and creative industries tax relief are all very specific reliefs that are available for obviously companies in the creative industries, companies with patent income, companies who engage in research and development. They are incredibly valuable reliefs. So I've included slides in here, just as a point of reference for you when you are working out some of your tax strategies. So they're super important. They only apply to certain companies, and I don't have time here to deal with them in detail, but I've included the slides for your reference. I did want to mention with group relief, I think we've already talked about that. Again, there's a number of provisions which we can use for businesses that are organised as groups of companies. For me, it's all around ensuring a group's not disadvantaged. So it's no different because I've decided to commercially split my business up than if I'd just done it in one entity. So it's allowing us to ignore often those boundaries. You need to look at everything really carefully with group relief, because there's a lot of TARs to negotiate, because it's often an area of abuse. But we just, again, would be a topic in itself. So it just is a broad mention. But I do want to spend a little bit of time on reinvestment relief, just making sure that you people are aware of its scope. Again, something that I've come across quite often in practice where people haven't realised it's available. So if we have a chargeable gain, a company doesn't pay capital gains tax, but it does pay corporation tax on its chargeable gains. It's very similar to an individual's calculation, although it doesn't have an annual exemption, and it does have indexation up to a certain point. So we do, where we've held the asset for a while, we need to consider that. But fundamentally, if we sell a qualifying asset and we reinvest the proceeds into another qualifying asset or assets, then and the reinvestment takes place from 1 year before the disposal of the chargeable asset to 3 years afterwards, then we can effectively defer the tax that we have to pay on the chargeable gain. Now, it applies to land and buildings, fixed plant and machinery, so not all plant and machinery, and goodwill, prior to April 2002, if we've got that in our business. If we use it for non-trade purposes during the period of ownership, or if we only partly reinvest the proceeds, then our the amount of gain that it can be deferred is limited down. Just be mindful of that. And we have 4 years from the end of the accounting period in which the gain is made to make a claim. So I think where people sort of not really make mistakes is that they don't look at the time frames, and also within the context of a group, one can sell and the other can buy. So in a group structure, we have to look at it holistically, and we might still be able to claim the reinvestment relief. Just bear in mind that if we reinvest into a depreciating asset, which is any asset with a useful life not exceeding 60 years, then the gain isn't deferred, it's just going to be frozen, and then it becomes chargeable on the earliest of the sale of that asset, or if you don't use it in the trade, or 10 years after the acquisition of the depreciating asset. So it will be a depreciating asset pretty much if we buy fixed plant and machinery, or if we invest in a short lease. So we would be, and that, so yeah, as it says, lease and fixed plant of machinery. So what do we mean by fixed plant and machinery? There's a big definition. We know it needs to be plant and machinery first of all, but it'll be fixed if it's that will be if it's into the building, so it's not part of the, if it's not part of the building, it will be a depreciating asset. If it is part of the fabric of the building, like lifts and things like that, then that will be fine. It won't be a depreciating asset. There's just something that a few that we should be aware. We don't have to use them in the same trade. If we're a group, I've already said, we don't have to be the same company selling and buying. We don't have to have old and new assets in the same category. So, we can sell land and we can buy plant. And sometimes we can do parking. So say we buy something that's a depreciating asset. We can defer it, but we know we're going to have to, it's only for 10 years. If at some point we can actually then buy a non-depreciating asset, we can effectively roll into that. And then that will extend the period for rollover relief. It's sometimes called parking because it's a lot easier to identify companies with depreciating assets rather than non-depreciating assets. So we get it, we've put it on one side, and then as and when the 10 years comes up, we effectively, it can be rolled over into the new one. All right, so that was a super canter through that, but I did want to talk a little bit about creating a tax mitigation strategy. So if one of the very first slides that I did this morning was this about balance. So we don't want to be paying any more than we have to, but we don't want to get it wrong either. So how do we effectively go around and deal with that? Well, we need a tax strategy, and of course we'd love to be paid by our clients to help them formulate this. But as part of that tax strategy, we've got lots and lots of things to think about. So we need to understand what our tax objective is. We've had something like some people have a bigger risk profile than others. So as part of that, it's like, what's our attitude to tax planning? We're willing to give it a punt. I used to have a client who was very happy as long as he earned more than he paid. And when they then pushed the certain income tax rates went up to, at that time, up to 50%, he then became interested in tax planning. So what's our attitude? I had another client who would not contemplate any kind of tax mitigation strategy unless it generated more than £1 million worth of savings. So we've got everybody has, so understanding our client's attitude is very important. We need to know what process we're going to follow once we've worked out what our tax objectives and standards are, how do we make sure we follow it? Who's going to take responsibility for that in our organisation? How are we going to manage our tax risk in the context of following that tax objective? If our tax objective, for example, is to pay as little tax as we possibly can without getting caught, then how do you manage that? Not saying you should have that, but I'm just saying a tax objective is very personal to an organisation. How often should we review our strategy? If we've got somebody being responsible for it, do they need training? Does anybody else need training? As part of our tax strategy, do we want to take the debate to the government? There are some companies who, respond to consultations and things as part of their strategy. Is that something your client wants to do? What relationship do they want with the tax authorities? Are they going to be? Do we want to build up a personal relationship with our inspector, within sort of obviously professional boundaries, of course, or do we want to, just deal with them when we've got an issue? Do we need external assistance actually? Is this something we can do in-house, or do we actually need advisors to help us get there and decide? And it's absolutely vital. If we're a large company, we have to publish this. So we can't just say this isn't something we want to do. But I actually think this kind of thought process, even if it's informal, even if it's just a bit of a chat on the golf course, to get our clients thinking about their attitude to tax, helps us very much as advisors in giving them the right level of advice. And so I've just got now a couple of examples from FTSE 100 companies published tax strategies to give us an idea. They're not the full ones because they tend to be massive, but giving a full idea, a bit of an idea about a direction of travel. So this particular one is actually quite renowned for not doing tax planning. And they say they do not support or implement tax planning that they believe to be aggressive or artificial, but they will still take appropriate and responsible steps to reduce tax liabilities and make use of available reliefs and incentives where it reflects the commercial and economic activity of the business. So what we've been talking about today, very much that last sentence. They conduct transactions between their group companies on an arm's length basis in accordance with transfer pricing guidelines. Multinationals do always say this, and we always, in all countries where we have activities, we generally have a business there. So they're basically saying that we've no sort of tax haven, empty shell companies going about, saying they are not committing to their level of defined acceptable tax risk. This gives them flexibility, assessed on a case-by-case basis, but they take a balanced approach having regard to the interests of all stakeholders, including investors, customers, staff, etc. So wide. Remember, corporate governance theory, traditional theory says that we exist purely to generate shareholder wealth. Other theories say that we've got wider stakeholders. This company is acknowledging wider stakeholders. So when you read that, you might think, well, that's super generic. Why anybody could write that, doesn't really mean anything. But then I've got one from another that I found, and this is a FTSE 100 that's in a dispute. So they've got to kind of do a strategy that is compliant, but actually they are in dispute with HMRC over a project. So they say to pay tax on profits according to where value is created within the normal course of commercial activity. But any exceptions to this are compliant with local laws and fully disclosed to the tax authorities concerned. So very different attitude to the one beforehand. We do not seek to avoid tax by establishing arrangements that we consider to be artificial in nature, but we do claim available tax incentives and exemptions that are available, and we do things basically that are accepted as mainstream tax practice amongst the tax community. It is complex, so in any country that we operate, we will recognise that a view on practice evolves over time. So we do very much adhere to the prevailing practice and attitude of the relevant tax authority. So where the first we can see still generic, but very, very different. And I think as a starter for 10, that's where we really have to be with our clients, understanding where they are coming from. So how do we actually make this work for our clients, for ourselves? Of course, recognizing that although the vast majority of people here are on advisors, they're also in business. But maybe not companies. So first of all, we've got this big collation of information exercise. Like, how much corporation tax does this company actually pay? How does that compare to their total tax contribution, both in the UK and worldwide? What's the business that they've got? Is there any scope for any of these sort of reliefs? So we need to know what they do. Do they have any non-trading elements? Where do they operate? Are those countries that have got double tax agreements? And what are the growth plans and expectations? If it's got loads of losses, but we don't think we're going into profit, then we're really looking about maximising losses. If we have, we're looking to expand and buy things, that will be a different sort of priority as well. So once we know what's happening, then we can determine the relevance of all the various tax reliefs. So understanding what all the current reliefs and exemptions are. And that's really what I've tried to do today, is to create sort of just a wider awareness of what is out there. What potential reliefs apply in our circumstances and what might become relevant in the future. We might not have, we might be loss making at the moment, but we might be expecting to go into profit, and we might want to diversify with different businesses. We might be expecting to sell part of our business. So can we sort of structure that appropriately? We might be working overseas predominantly, so is it right that we have a UK resident company? So we need to understand our future line of sight. Once we've got that, then we can create our baseline. So we will assess the company's attitude to each aspect of their tax strategy. Remember the bubble slides that we had beforehand, actually get an answer on that. And from that, you can build a policy. Which is really about making the most of what you've got. None of the things that I've suggested in mitigation are remotely even slightly aggressive. They're super passive and super sort of, but as we've already seen, there's a lot of money to be made there for our clients, because this 45% tax gap relates to error and not taking reasonable care. So I would say there is actually quite a lot out there that we could do, and that's not even about making the most of it. That's just like getting it right. So they will be very happy, HMRC, to not let you, if you don't claim a deduction, not to give you it. So I imagine there's even more money out there through maximisation. Make sure your responsibility and accountability is allocated. Make sure you've got management and monitoring processes in place. It's absolutely pointless building a policy and then not implementing it or not having the documentation to follow it through. So you need all that and the training. And then going forward, you just need to evaluate it all the time. You could do one this week, and then you could have the budget, and like half of it could be irrelevant. So you need to have an ongoing review. I hope it's not all irrelevant. I don't think it will be. I have tried to build it around places that will make sure it's not irrelevant after the budget. So I'm hoping it has more than a 2-week shelf life. But again, you never know. My point is that we do have to look at things as we go along. Okay, so I think that's where I want to finish with 5 minutes. So if we've got any questions, I'm going to just stop the share there. And I think we have got a couple of questions. So let me have a look first of all. So your client is, so I've got, let me just see that question. I'm going to roll up on that question, see the top of it. So I'm assuming, Jonathan, that you've got a limited company, your client is an individual. So, or is it a Gibraltar company? So if somebody, but generally I'm assuming that your Gibraltar-based company owns the UK company. But if if they do, then if it does work in the UK, there's a risk that it would also create a permanent establishment of the Gibraltar company in the UK. So where you do work, but you are the company that's overseas doing work, even if you've got a UK subsidiary, you could still create a permanent establishment by the side of it. So that would be what you would need to look at. If it's an individual, then if he's UK resident, he's going to be subject to tax on his worldwide income and gains, subject to any double tax treaties. So some of these. And let me look on the Q&As. Yes, okay. If you had set up a website, so one of the questions here is there no deduction or tax relief for website costs if capitalized? So if you are creating we can't argue that it's plant and machinery, but if the setup costs are not deductible, they're usually treated as capital, but the ongoing costs you can claim a deduction. Yeah, so reinvestment relief. Joanna's asked if reinvestment relief relates to landlords whose portfolio is within a limited company. Reinvestment relief is also a capital gains tax relief. Would be, so I'm assuming those are individuals, and they have to reinvest their shares. So it's whether their shares are a qualifying investment. And it won't be because it won't be a trading company, I'm assuming, if it is a company portfolio. So, yes, theoretically, but probably doesn't apply to a company where you've got it all sheltered within a limited company. And it's just property. So. Okay, so thank you very much for everybody joining. I think I've got everybody's questions. If I haven't answered them, let me know, or drop a note to the K3 Hub afterwards, and I'll be very happy to give you a proper answer by email. Thank you very much.